All right. Good morning, everybody. Welcome to our YouTube session this morning. The pros and cons of in the money versus out of the money options. All right. Can you guys hear me? Give me a thumbs up. Shar, can you guys hear me? You can see the screen. Can you hear me? Just let me know that you can hear me. Yes. No. We cool? Anybody? I can hear you. All right, we're good. Okay, so I say good morning because I'm here in Napa Valley, California. It's only 10 o'clock, 10 in the morning. Obviously, back east, it's lunchtime, and in the UK, it's a happy hour or dinner. So wherever you guys are logging in from, it's either brunch, lunch, happy hour, dinner, or maybe even tomorrow morning if you're in Asia. So welcome. Thanks for spending some time with us this morning as we talk about options. I know you saw a little bit of the Pinnacle workshop schedule. We'll talk about that at the end of the webinar. But all right. So today, now this webinar, I do these on a monthly basis, and a lot of these sessions that I've done have really been for beginners, maybe for people who haven't traded options at all. And who are new to options, still learning how to spell option. What is a basic option? How do you make money with options? How do they move? Today, we're going to talk about. This is really for folks who have a little experience with options, because options are a unique asset class. By the way, please put any questions in the chat box if you've got them, and we'll address those. We should have about an hour together, give or take a few minutes. And now, I think options are the greatest thing ever invented. Okay, maybe not as good as single malt scotch, but I think options are the greatest financial thing ever invented. And the reason for that is options are the only asset class where you can be wrong on the direction of the trade and still make a profit. Meaning you can enter a bullish options trade, the stock can go down and you can make a profit. You can enter a bearish options trade, the stock or the underlying asset can go down and you can still make a profit. You can be wrong, just not really wrong. Okay, I mean, you can't be Enron wrong or Bear Stearns wrong. I mean, if you're that wrong, you probably deserve to lose some money. But it is the only asset class where you can enter a trade and have the possibility, certainly not a guarantee, but have the possibility of making a profit. And the reason you can do that is right here, out of the money options. Okay, because options are the only asset class that has what we call extrinsic value. Now, what is extrinsic value? Well, there are two types of value, intrinsic and extrinsic. Intrinsic is the price of what something's worth. So if a stock is trading at 150, that's the price of the stock. That's the intrinsic value of the stock. That's it. Okay. If an oil is trading at $111 a barrel, you go long an oil futures contract at 111. That's the intrinsic price of a barrel of oil. If you're trading forex lots, whatever the exchange rate is, the pips, the pip movements, the pip spread, that's the intrinsic value of the asset. Does that make sense? And you can, when you trade stocks, futures, and forex, you are only trading the intrinsic value of what it's worth. So let's say a stock is trading at 200. You can't buy it at 180. You can put in a limit order to buy it if it goes down to 180, or you can put in a limit order to sell it if it gets to 210. But if it's trading at 200, 200 is the intrinsic value price of the stock, and that's the only price you can trade the stock at that particular moment in time. Does that make sense? Okay. So the same with futures contracts, okay, and the same with forex lots. So right now, oil, I just mentioned oil a second ago. Oil is up today. It's at $113.54 a barrel. Well, if you're going long oil, an oil futures contract or oil going long the oil, that's what you're paying to buy the oil, or that's what you're collecting if you sell oil short. Okay. That's it, the intrinsic value. When you trade intrinsically, okay, if you buy a stock, it goes up, you make money, goes down, you lose money. If you short a stock, it goes down, you make money, it goes up, you lose money. So you're trading directionally, and if you get the direction right, you have to make a profit. Okay? There's no volatility, there's no time decay, there's none of that. You buy a stock at 200, it goes up to $200.05, depending on the number of shares, you've made a profit. You short a stock at $200 a share, it goes down a penny, you're at least in the black. Okay? Okay. So when you go long or short, stocks, futures, or forex, those are directional trades. If you get the direction right, you make money. You get the direction wrong, you lose money. What makes options unique is not just that they have an expiration date, because futures contracts have an expiration date. But what makes options unique is options not only has an expiration date, but the number of days between now and the expiration date, that time, we not only have intrinsic value, the option premium has extrinsic or time value. So when you trade stocks, futures, or forex, you're trading the intrinsic value of the asset. But when you trade options, buying or selling, you're not just trading the expected directional move, you're not just trading the intrinsic value, you're trading the extrinsic value. You're also buying or selling time or extrinsic value instead of just the value of the asset. Okay, does that make sense? And this is what makes options unique. A lot of people think options are risky, and they're the riskiest asset class. Okay, well, certainly option trading has risk. Every asset, every trade, every investment, whether short-term, long-term, has risk. There's certainly no guarantees, but I like to think options have a higher probability of making a profit in an option trade, because half of the option trades that exist, you can be wrong directionally and still make a profit, or the underlying stock doesn't even have to move and you can make a profit. However, when you are directional and you're buying options, if you buy the wrong option or the wrong expiration date or the wrong strike price, you can still be right directionally and lose money. And that's what's fair about life. I mentioned a moment ago, if you can enter options trades where you can be wrong directionally and make a profit. Well, if you can be wrong directionally and make a profit, that means there are options, that it's possible to be right directionally and not make a profit. So if you're new to options today, that's a new concept for you. If you're new to options today, geez, how can I enter a trade, a bullish options trade, the stock goes up and I lose money? It's possible. So what I'm going to do today is going to show you that all options are not created equal. See, most people think they understand the basics of options. Now, there are only two options, calls and puts. That's it. Okay. And if this is even newer for you and you don't have that kind of experience, then go back and, you can either join us in some of our webinars or you can learn a little bit more about options. But a call option gives you the right to buy a stock at a set price, no matter how high it goes. A put option gives you the right to sell a stock at a set price, no matter how low it goes. That's it. There are only two options, calls and puts. Okay. And you can only do two things with an option, buy them or sell them. That's it. So what I'm going to walk you through now, and it would help if you had an understanding of options, is the difference between an option that is in the money, that has intrinsic value, and an option that is out of the money, that has no intrinsic value, but has time value. Okay? And again, options are the only asset class that the value of the asset is more than it's worth intrinsically. Okay, until we get to expiration. So, buying options. We're going to talk about directional trades. And for this example, I'm going to talk about your bullish. You're thinking a stock is going to go up. So I mentioned a moment ago, there are only two options. Put options gives you the right to sell a stock at a set price, no matter how low it goes. Like an insurance policy. You have a $50,000 car, you total it, you can still sell it to the insurance company for 50 grand because you bought an insurance policy. And a call option gives you the right to buy a stock at a set price, no matter how high it goes in the future. Think of a supermarket coupon. Okay, you have a 99-cent a coupon that says you can buy a bag of Doritos for 99 cents. You get to the supermarket and the bag of Doritos is $5. You still get to buy them for 99 cents. They raise the price of the Doritos to $10. You still get to buy them for 99 cents. Okay, until the coupon expires. Well, that's all a call option is. Okay, if a stock is trading at 200 and you buy a 200 call option, a call option at the 200 strike price, you can buy that stock at 200 even if it goes to 300 or 400. For the same reason you can buy the Doritos for 99 cents even if the bag of Doritos goes to $10. Make sense? Okay. Now, options are the only asset class where what you're trading can either be in the money or out of the money. Okay? Now, in this example, I'm using Goldman Sachs, and this is in the past. This is not today because I had to prepare the numbers. But this was when I put this presentation together. This was live a while ago. Okay, so on the day I did this, Goldman Sachs GS. Now remember, the stock was trading at 226.26. Now I said there are only two options: calls and puts. Options are also traded in contracts, and each contract gives you the right to buy or sell 100 shares. So just like futures, you're trading an oil future, you have the right to buy or sell 1,000 barrels of oil. You're trading gold futures, you have the right to buy or sell 100 ounces of gold. Options, it's 100 shares of stock. So if Goldman Sachs was trading at $226.26 a share, and you were going to buy 100 shares, of course, you could buy less, but for comparison purposes, we'll just use 100 shares. It would cost you $22,626 to buy 100 shares of Goldman Sachs. That's it. Okay? Okay. Now, let's say for our purposes, your profit target, target one, your profit target at the supply zone, you could call it resistance if you want. We call it supply, because there's a difference between supply and resistance. Resistance is just maybe the highest price it ever traded. Supply is where the probability of there being sell orders would exist. But whatever. Let's just say your profit target was at 240. Okay, so you're going to buy the stock. Now let's say the stock is at demand. It's at a demand zone. It's at a price point where you think it's going to rise for whatever reason you think it's going to rise. Now I just want to divulge here for a second. Hopefully when you're trading, for those of you with experience, you're not just buying a stock because Kramer threw a chair at the screen and went booyah, or you're not just buying a stock because you heard a rumor or you got some intuition or you read an article without looking at why you think the stock is going up and where you think the profit target is. But for our purposes today, say the stock is at a demand area and you think it's going to rise, and the stock is at $226.26 a share. Okay, your profit target is 240, meaning you're going to buy the stock at 226.26. If your target to sell it for a profit is 240, and you would have a stop loss at some point below 226, depending on where your demand area is. Okay, so you think the stock's going up to 240. If the stock, and by the way, there is never a guarantee when you get into a trade. So if the stock gets to 240, which is, you're buying it because you think it's going up. If the stock gets to 240, you would have a profit of $13.74 a share, or $1,374 on your 100 shares. Okay, that's a $1,374 profit and a 6% rate of return. Woohoo! Anybody have a problem with this trade? Well, the only problem you might have is the cost of entering the trade. Now, of course, you don't have to buy 100 shares. You could buy 50, you could buy 10. I mean, if a stock gets too expensive, it almost doesn't pay. Yeah, you could buy, one share of Amazon, but I mean, you're only buying one share. So, for every dollar it goes up, you're only making $1. You know what I mean? But you bought 100 shares. And a lot of people can afford, especially if you're trading stock in an IRA, that is the largest account a lot of people have. So let's just assume you can afford the stock. A lot of people buy Goldman Sachs, but you bought 100 shares at 226. The target was 240. You made a $13.74 profit, a 6% rate of return. That's great. Okay. And let's say you had a nice little 10% stop loss. I'm just using that for round numbers. Some people would have a smaller, depending on how close to your demand zone or how close to your support line you're getting in, you might have an even smaller stop loss. And what's interesting is, if you had about a 6 or 7% stop loss, it would be about $1,400. And that's going to be important. We're going to talk about that in a few minutes. All right. So I just want to be clear. You're buying 100 shares of Goldman Sachs at 226.26. You have a profit target at 240, and you're willing to risk couple of grand on the trade, give or take. All right. Now, with Goldman Sachs at $226.26 a share, okay, we're going to buy to open a call option, which gives us the right to buy Goldman Sachs at around 226, and we're going to sell to close the call when the stock gets to 240. See, options are derivatives of stock. So another mistake that some people make, and I see all of these, on Facebook, I see all of these trading groups and option groups and broker groups, and people post questions about an option trade that they're in or an option trade that they're thinking of getting in without regard for the underlying asset. So options are derivatives of a stock. Okay. And again, if you're really new, then just bear with me. But hopefully today you're on this webinar because you've got a little more experience. So the only reason you would buy a call option, because buying a call option gives you the right to buy a stock. So the only reason you're buying a call option would be the only reason you're buying a stock. You think the stock is going up. Because if you buy a stock and it goes up, we know you make money. Well, if you buy a call option and the stock goes up, you're going to make money. Okay? So when the stock is at 226.26, we're not going to buy the stock for $22,626. We're going to buy a call option and open an option trade. We're going to open a long bullish option trade. And we're going to sell to close that call, hopefully for a profit when the stock gets to our profit target, which would be, in this example, $240 a share, which is the supply zone. Okay? Now, the purpose of today's session is in the money options versus at or even out of the money options. Okay. Now remember, options have intrinsic value and extrinsic value, and I'll explain that in just a second. So let's say in this example, we went out in the future. We went out to May. Okay. And we bought an option, a $210 call option. That gives us the right to buy Goldman Sachs at 210, no matter how high it goes. Well, wait a second, Steve. The stock's not trading at 210. I understand that. But remember, options are like coupons, and you can buy different strike prices, okay? And you can buy different expiration dates. You can go further in the money. This option is in the money because it has intrinsic value. I'll explain that in a second. Now, this option is going to cost us $18.65. And as I mentioned, options are sold in contracts, and each contract gives us the right to buy 100 shares. So if the option has a premium of $18.65 to buy one call option, would cost you $1,865. Okay. Now, by the way, you buy 100 shares of stock for $22,000, or you buy a coupon or a call option giving you the right to buy the stock for $1,865. Options are a leveraged asset. Now, your target, we said, was $240. Now, the intrinsic value of this option, if the stock gets to 240, the intrinsic value of this option has to be $30. Now, where does that come from? Well, we have the right to buy a stock at 210. Right? Right. If you buy a May 210 call option, you didn't buy the stock. Remember, a couple of slides ago, we bought Goldman Sachs at 226.26. Now, when the stock is at 226.26, we're not buying the stock. We're buying a call option, which is giving us the right to buy the stock in the future. How far in the future? Up until the expiration date in May of that year. Okay. Now, we bought a 210 call option. Our profit target on the underlying stock was 240. Let's say it's expiration day. There's no more time left. The stock is at 240. Guys, if you exercised your option, now remember, the stock is now at 240, but what price do we get to buy it at? 210. Why can I buy a $240 stock for 210? The same way you can buy a $10 bag of Doritos for 99 cents because you had a coupon. Does that make sense, everybody? So it's expiration day at 4 o'clock Eastern time. The stock is at 240. If you exercise this option and bought the stock at 210 and sold it at the current price of 240, you would get 30 bucks. So the option is worth $30. What did we pay for it? $18.65. What is our profit? $11.35 or $1,135 for the option. Does that make sense, everybody? Okay? And again, if you really are brand spanking new to options and you don't understand what we're talking about, maybe this isn't the webinar for you. You know, either join us at Pinnacle or learn about some options. But we have a lot of different strike prices and a lot of different choices when it comes to options. So if we bought this option, we made a profit. Now, obviously, just like if we bought the stock and it went to 240, we made a profit. If the stock went down, we took a loss. If we bought this option and the stock went up, we made a profit. If the stock goes down, we would take a loss. This is a directional trade, just like trading stock, okay? Except it's a leveraged directional trade. If you bought 100 shares of Goldman Sachs for $22,600, what's the most you could lose? $22,600. If you bought this option for $1,865, what's the most you could lose? $1,865. Okay, this is the in the money option. Now, that was an $11.35 profit, 1,135 bucks on the contract, and a rate of return of 61%. The stock only returned a 6% rate of return. This in the money option is generating a 61% rate of return. And we're going to come back to that. We don't pay our bills with rate of return, but we're going to come back to that. Now, let's look at an at the money option, okay? Why is this at the money? This is the strike price closest to the current stock price. So the stock is usually, options are at this price stock, options are usually in $5 increments. So there's a 210 call option, a 215, a 220, a 225, a 230. How do you know which strike price to pick? How do you even know which expiration date to pick? You have to learn about that. So we're not going to get into that today. Today's topic is in the money versus out of the money. Okay? So if the stock is at 226, I can buy what's called an at the money option. It is the strike price closest to the current stock price. Now, it's going to cost me less money than the 210 call. Why? Is it going to cost me less money, only $7.60 or 760 bucks? Because the intrinsic value is less. We're literally buying an option that is worth intrinsically less money. This option, if it gets to the profit target, it will only have $15 of intrinsic value. And on the day we're buying it, it has less intrinsic value. This option here, the 210 call, has $16.26 of intrinsic value. This option only has $1.26 of intrinsic value. So we're buying less real value. We're still paying for time because both of these May options have the same expiration date. Okay, but we're buying less real intrinsic value. Okay, so that's why we're paying less money. Now, let's say the stock does what we think it's going to do. It gets to 240. Okay, remember, here we bought a 210 call. If we exercised this option and bought the stock at 210, sold it at 240, they're going to give us 30 bucks. Well, here we bought a 225 call. Stock gets to 240. We exercise this option. We buy the stock at 225. The stock gets to 240. The option at expiration is only worth $15. Huh. It's worth less than this one. Now, first of all, you know the expression, you get what you pay for. That's going to come into play here, okay? So this option was only $7.60, $760 for the option or the coupon, less than 50% of what it costs for this option. Most people are already thinking, geez, why would I pay more than twice as much for this option than for this option? So that's a good question. And if you don't understand options, it's an even better question, but you'll see why in a second. First of all, if the stock gets to our target on the expiration day of the option in May, take a look. We actually made less profit even though we got a higher rate of return. So let this sink in for a second. You know, think about anything you buy in life, guys. You don't go out and say, I want to buy the cheapest car I can find. Let's buy a Pinto. Remember those? A Ford Pinto or I forget some of those other wacky cars from the 70s. Very rarely does someone go out and buy the cheapest thing they can find. Okay? Because usually the cheapest is not put together the best. I mean, look, I'm not a car guy. There's a reason a Mercedes costs more than a Yugo or a Hyundai. I'm not making fun of Hyundais, and I'm not a car guy, but there's a reason that a Mercedes could cost $100,000 and a Hyundai could cost $35,000. Now, some of it is intrinsic value, and some of it is marketing and perception, and I'll give you all that. But nobody's buying a Yugo. Nobody's buying a Pinto or a Gremlin. Remember those cars? Okay, so you get what you pay for. Now, remember, let's use the car analogy for a second. You rarely go out and look to buy the cheapest car because it's probably put together, not great, won't last as long, whatever. Okay? Remember those old Volvo commercials back in the day with those crumple zones? The car would crash and the baby in the car seat would get out without a scratch. Yeah, they were selling value. They were selling safety, and they got to charge more for the car. Now, what you do is there's a difference between cheap and value. Okay, once you decide the car that you want. So let's say you go, I want a BMW. I want a BMW 328i. I want the moon roof, the CD player, the leather seats, the cold weather package, blah, 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 blah. Once you find your car and you customize it the way you want it, then what do? Now you shop it around from dealer to dealer. You're not buying the cheapest car, but if you can get the exact same configuration car for less money, that's value. Okay? Now, while these may be, and sometimes you'll pay a little more for the value. Okay? So this option is less expensive. It is cheaper. You're risking less. However, if your target on the trade is only 240, you don't have the right to buy. You didn't buy the stock at 226 and are selling the stock at 240. You didn't buy the stock at 210 and selling the stock at 240. You bought a coupon. You bought a call option that says you can buy the stock at 225. Well, if it gets to 240, it's worth 15 bucks. You subtract what you paid. Your profit is 740 or 740 bucks for one contract. I know this sounds sexy. Got a 97% rate of return, but you made less money than the guy who paid more than twice as much money for the same directional move. You get what you pay for. Now, don't get me wrong, guys. In May, when you're at a Memorial Day party in your neighbor's backyard and you got a scotch and a hot dog in your hand, and someone says, "What do? I trade options. Hey, I did a trade on GS. I got a 97% rate of return." That sounds impressive. Okay, that really sounds impressive. People are going to go, "Ooh, fabulous." Yeah, well, this guy only got a 61% rate of return, but he made more than 50% more profit than you did. We don't pay our bills with rate of return. Now, that's an at the money option. Now, what the topic of this webinar is today, in the money versus out of the money. How is it possible to lose money when you get the direction right? Here's how. Now, we're going to talk about these deltas in a few minutes too, but okay, let's look at the out of the money options. Okay, the stock is at 226.26. We're going to buy a 240 call option. Now, wait a second. I could go buy the stock right now for look, I understand why somebody's buying a 210 call. The stock's at 226. I can buy it for 210 if it goes up. That makes sense. Stock's at 226. I'll buy a 225 call. I can buy it at 225 if it goes up. Makes sense. But why would I buy if the stock is at 226? Why am I going to pay money for the right to buy a stock at a higher price? Well, one of the reasons is right here. Look what this option is going to cost me. Next to nothing, $1.80. Remember, this option, we paid $18.65. The intrinsic value of this option, though, is $16.26. The intrinsic value of this option is still $1.26. This option has no intrinsic value. None. Zip. Nada. What we're buying, the $1.80, is time. That's all we're buying is time value. There's no intrinsic value. You are literally buying something that is intrinsically worthless. Options are the only asset class where you can buy or sell an option that is intrinsically worthless. You can't sell a stock at zero. It's zero. You can't buy a stock at zero. If a stock is intrinsically worthless, you can't trade it anymore. Matter of fact, they won't allow you to. You can't buy and sell a stock at zero. Okay? But options have expiration dates where you are buying and selling time or extrinsic value in addition to what it's worth intrinsically. And the only reason people do this is A, they think the stock is going to really go higher and they'll make money, or they go, gee, I can't afford $1,865, but I can afford $180 for one coupon. I got a small account. I can afford that. Well, guys, I'm going to tell you right now, you should never make the wrong option trade. You should never buy the wrong option because that's the one you can afford, and I'll show you why in a second. Okay? Now watch this. We already said if the stock gets to 240, which is our target, what is the intrinsic value of a $240 call option? Well, here we could exercise the option, buy the stock at 210, sell it at 240, we get $30. We made a profit. Here we exercise our option, we buy the stock at 225, we sell it at 240, they give us $15, we make a profit. Here we exercise the option, we buy the stock at 240 and we sell the stock at 240, we don't make a profit. It has zero intrinsic value. Okay, it's worth nothing, which means the stock went up almost somebody bought this option. The stock went from 226 to 240. The stock went up $14, $13.74, and they lost 100% of what they paid. They took a max loss on the option trade. Remember, guys, this is the Pinto. This is the Honda. This is the Mercedes. Now, again, I'm not a car guy, and you know what I'm saying. You get what you pay for. Okay? And if someone doesn't understand the intrinsic versus extrinsic value component of an option premium, if all somebody thinks is, gee, I read Options for Dummies, I read a book on option, you buy a call option, the stock goes up, you make money. Well, if that's what you're thinking, I understand. Why would somebody buy an option for $18.65 if they could buy an option for $1.80? Well, that's like saying all cars are made, all cars are equal. What does college cost? I don't know, I think Harvard costs a little more than a 2-year community college. I'm not making fun of anybody's college, okay? And some people don't think Harvard's worth it. Maybe it is, maybe it isn't. But Harvard, Princeton, Yale, Dartmouth, okay, Stanford, Berkeley. I mean, you get what you pay for, okay? And hopefully there's a return on that investment, okay? Now, does everybody understand what we did here, okay? Now, Delta just tells you how much your option premium will move, when you're up, when it's a conversation for another day, okay? But notice, the stock was in the same place, 226.26. We could have bought this option for 18.65, this option for 7.60, or this option for only $1.80. And by the way, you want to know another big retail mistake? Well, wait a second. If I was willing to buy this option for $18.65 or $1,800, why don't I just buy 10 of these? Matter of fact, 10 of these is still less than one of these. And how would you feel if you bought 10 of these? The stock went up almost 14 points and you lost the whole $1,800. We have support groups for you, okay? Any questions? Does this make sense, everybody? Okay? So you have to understand, now, first of all, this was a trade at the time on Goldman Sachs. So you had to have been looking at a chart. You had to have been looking at the clues or the footprints, technical analysis, chart patterns, whatever reason you had to believe Goldman Sachs was going up, okay, was the reason you were going to buy the stock or buy one of these call options. And obviously, if Goldman Sachs had gone down, we were going to lose money. And yes, if the stock tanked, you would have lost a lot less here than you would have here. However, every trade plan has 3 components. We teach this at Pinnacle. Every trade has 3 components: entry, stop, and target. So yes, while you spent $1,865, if you were wrong on the trade, you weren't going to lose, or you shouldn't lose, $1,865. If you had a stop loss and you knew you were knew you were wrong right away, you would close the trade as soon as you were no longer bullish on your trade. Okay? So the cheapest option was actually the worst trade if this was your target. Okay? Now, let's talk about break even. Okay? Another benefit to this in the money option. We're assuming that the stock is going to get to our profit target of 240. Now, obviously, when you get into a trade, there is no guarantee that that's going to happen. There is never a guarantee that any trade you enter will be profitable or that it will make it to the opposing zone. However, if we're buying a 210 call, even if our profit target is 240, if this stock just gets to 228.65 by expiration, we break even. Why? Because if we bought the stock at 210, sold it at 228.65, we would get back 18.65, and that is our break even. Okay. Yes, you spent less money for this option, but look what the break even is. The stock had to go up almost $4 higher just to break even. If the stock was trading at 232.62, this stock would be worth $7.60. You'd break even. We were already profitable here at 228. If the stock went to 232.60, this option would be worth $12.60. We'd have a nice profit. And finally, this $1.80 option, the break even is above 240. We're talking break even now. On expiration day, if the stock was only at 240, you lost the whole $1.80. This stock has to get to 241.80 above your profit target just to break even at expiration. Now look, options are a probability game. Whatever your profit target is, I respect that. But options are a probability game. Which is a better probability? The stock gets to 228, 232, or almost 242. Probability is if it's going, I mean, it's going to be easier to get to here than here or here. Look, obviously the stock could go to 300. It could go to, but we're talking probabilities. Does this make sense, everybody? So not only did we make more money here, we had a better probability of making it. And by the way, I mean, again, it's only a 61% rate of return. Look at that break even. Okay, so we made it easier to make a profit. Now, by the way, and I'm going to even show you, because usually at this point when I talk about this, somebody says, well, what if we just bought 2 of these? That's still less than 1 of these. And if the stock made 240, you would have had more money. But the stock would have, I'll show you that in just a second. Okay, look at your profit. What was the best trade out of these 3, assuming it got to our profit target? The in-the-money option. Now, why do traders buy out of the money options? Aside from their being cheap, they want to win a lottery ticket. Look, if the stock goes higher, I'm going to show you in a second, they want bigger profits. It's a lottery ticket. They want to brag about really sexy rates of return. I see these on Facebook and Twitter all the time. Someone goes there and says, I bought call options on XYZ and, 1,000% rate of return. Okay, fair enough. But remember that out of the money option that only cost us $1.80, that had to get to 240, 180 to profit. What if 240 isn't just your target, but what if 240 is your target because it is a supply zone? Okay? What is the probability the stock will break above the supply zone? Probably not good. Okay? However, let's say luck is treating you right today. You're living a clean life. Let's say the stock does shoot up and blows past 240. And again, if you're not sure what supply is, what we teach at Pinnacle, let's just say resistance. You're not expecting the stock to go above supply or resistance, okay? But let's say you're okay. Hey, something happened. News came out, something happened, blah, 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 and the stock closes all the way up at 250 on expiration day. Now, wow, that 240 call is starting to look real good right about now, is it? Right? Well, let's do the math, shall we? The stock gets to 250. You bought an out-of-the-money 240 call, okay? If the stock gets to 250, and remember, 250 is above supply, it's above resistance, that wasn't your target, okay? But if the stock gets to 250, your 240 call has $10 of intrinsic value. Well, what's your profit? Well, you have to subtract the $1.80 that you paid to buy the option. Okay, so you subtract the $1.80 and you have $8.20 of profit, or $820 for your contract. Wow, that's $820 on a $180 investment. That is a freaking 450% rate of return. You are doing your money dance. You are just doing you're just like, you're going into the bar, drinks for everybody. 450% rate of return. Well, as I just mentioned, ladies and gentlemen, we don't pay our bills with rates of return. We pay them with real dollars. So while a 450% rate of return sounds very sexy and amazing, it's only a profit of $820. Yes, it's $820, but it's only a profit of $820, and the stock had to rally 10 points above the supply resistance area to do that. Now, is it possible? Yeah. Look, I'm from New York. If the 69 Mets can win the World Series, anything is possible. Okay? That's why they play the games, because sometimes the underdogs win. Anything is possible, all right? But remember, this is about probabilities. Do you really want to enter trades with very little probability of making a profit? That's not the goal, okay? Now, let's do the math. while that out of the money option looks like the sexier, more profitable trade, and it does in hindsight, it's actually not the most profitable trade or even the trade with the highest probability of making a profit at the when you enter it, at the entry. If it does what you think it's going to do, it's not your highest probability trade or your highest profit. So let's compare. Okay, remember, $22,600 to buy the stock. The stock gets to 240. You have a $1,374 profit. That is a 6% rate of return. Woohoo! Okay, I know this should have said 626. I just rounded it to 0. Okay, there is our in the money option, the most expensive option, $1,865. Our profit was $1,135, and our rate of return was 61%. Now, by the way, remember I said you needed, if you're going to buy 100 shares, we're going to talk about this in a second. Many of you couldn't do this anyway because you don't have the right account size. This is certainly more affordable. Well, remember, the at the money option was $760, but we only made $740. But oh baby, I'm pretty sexy, 97%. Well, you want sexy? The out of the money option was only $180. We made $820, and that's only if the stock gets to 250, and that's the 450% rate of return. However, now let's talk about risk management, portfolio management. Look, I don't know about you guys. Would you put 100% of your account in one trade? I hope the answer is no. I follow a rule, and this is just a Stevie rule, one of my rules. My last name is Moses, so this is one of my commandments when I trade, okay? I would never put more than 10% of my account at risk in a single trade. It doesn't mean I'm willing my stop loss is 10% of my account, but I would never put more than 10% of my account at risk in case the hits the fan, okay? So if I was considering buying 100 shares of Goldman Sachs stock, I would need a $226,000 account, which means most people are not buying 100 shares of Goldman Sachs, okay? However, to buy that in the money option, I could do that in a less than $20,000 account. Now, I don't know how big your account sizes are, okay? I started my first trading account in 2004 with 10 grand in it. That's it. Okay, some of you are trading an IRA, some of you are just trading larger accounts. That's cool, okay? The at the money option. Well, you could do that. Here's another reason people go out of the money. I could do this option in a $7,600 account, and I could go out of the money in a $2,000 account. Guys, I get it. You've got a small account. You've got a $5,000 account. You're not buying stock. You can't buy this one. You can't even buy this one. You could buy this in a $1,000 account. But again, appropriate money management, okay? Not just small losses when you're wrong and larger gains when you're right, but how you protect. They say in the NFL, the league tries to protect the shield. Well, here the goal is protecting your account. Give up field goals on trades when you're wrong. Score touchdowns on trades when you're right. That's my trade plan. I call it the Moses field goal approach to financial risk management. When I'm in a trade and it's going against me and I'm taking a loss, I want to give up field goals. When the trades are working out in my favor, I want to score touchdowns. That way you can have more losing trades than winning trades and still be profitable. Okay? Now, you may say to me, Stevie, I only have a $2,000 account. I can't afford to do these. Okay? Well, I would say this. You're adults. You're wearing your big boy, big girl shoes. You do whatever you want. I would say don't buy the wrong option because that's the one you could afford. Don't enter the wrong trade because it's affordable. And as sexy as this 450% rate of return, and yes, it made more money than this one. Not than this one, but it made more money than this one. But the stock had a blow past supply or resistance to do it. So the account size represents what size account balance would be needed to put no more than 10% of the account at risk in the trade. Some people use 5%, some people might do 20%. That's up to you. But have rules, have trading plans, have rules to protect your account. Because by the way, guys, if you did this in a $10,000 account, now you are risking, almost 20% of your account in one trade. Okay, or in a $5,000 account, one call option here, you're risking almost 40% of your account. You can do it. There's no law against it. Matter of fact, no broker will try and talk you out of it. You go to the casino, you're sitting at the blackjack table, you want to push all your chips onto the table. The broker's not going to say, "Excuse me, sir, you think that's a smart move?" No, they're not going to say that. They're going to let you push all your chips on one spin of the wheel or one roll of the dice. Okay? No broker is going to, as long as you have the cash in a cash account to buy a stock or buy an option, or the margin to sell options to cover the risk, they don't care. They're getting paid either way. They're making commissions, they're collecting fees, whatever. They don't care whether you make or lose money. Okay? Hopefully you care. And, we are going to have losing trades. And not only are we going to have losing trades, but here was a case where if the stock only got to 240, you had a winning trade. I mean, a winning trade on the asset, and you still took max loss. Buying the 240 call and the stock only got to 240, you were right on the direction. And you took max loss on your option trade. Now, that, out of all this, was the best trade. Now, guys, I know what some of you are thinking. The stock buyer actually made more money. Yes, he or she did. They made an extra $240, whatever it is. But they had to spend $22,000 of an almost $250,000 account to make $230 more than you did. Really? And remember, what if they took a 10% stop loss? Okay? Even a 7% stop loss, they still lost the max you could have lost on your option. Now, which was the best trade? You tell me. There you go. $1,374 profit on the stock, $1,135 on the call. That was the cost. Even a 10% stop loss on the stock of $2,260 would represent a larger real dollar loss than losing 100% of the option premium. And you know what, guys? I mean, this is where trading psychology comes into play. Okay? 1865 is about an 8% of 22,000. So again, let's say you had a 7 or 8% stop loss on this trade, and you had a $220,000 account. Let's come back to here. You had a $220,000 account, and you took an $1,800 loss on a trade. Are you really? You know what most people are probably thinking? Man, I'm pretty good. I took a small loss. I took a $2,000 loss. I bought 100 shares of Goldman Sachs. I got a $250,000 account. I bought 100 shares of Goldman Sachs. The trade went against me. I took a small loss, only $2,000. I'm pretty good. All right. Yeah, you still lost more than the option guy if the option went to zero. And that should never happen to you. You should never take max loss on an option trade. Let me make sure you understand what I said. I didn't say you will not have losing options trades. I said you should never take the max loss on an option trade. I have been trading options since 2004. I have never, not once, taken a maximum loss on an options trade. Have I had losing trades? For God's sakes, of course. But I talked about earlier in the webinar, options have intrinsic value and extrinsic value. Extrinsic value we also call time value, right? Well, if you're wrong on a trade and you close the trade before expiration, there is still extrinsic value left in that option. So even if the stock were to tank and there's 2 weeks till expiration, your option will have 2 weeks of time value. So the only way you take max loss on an option trade is if you're wrong and then you don't close the trade, you don't get stopped out, you're wrong, and then you stay wrong. So for those of you with any experience, you're wrong. Delta takes you out of the trade if you're wrong directionally. Theta takes you to max loss if you stay wrong. The only thing worse than being wrong on a trade is staying wrong, because that's how little losses grow up to be big losses, or can grow up to be big losses. Does that make sense, everybody? Okay, so yeah, for an additional $239 of profit, okay, you were risking more with a 10% stop loss than 100% of what you paid for the option. And I already shared with you the break-even price, guys. You're looking at the prior profit and loss examples in hindsight, believing the trade had actually reached the $240 profit target and reached it by the option's expiration date. However, what if the stock only rallied to 230, not to 240 at expiration? So let me show you where that break even came from. Okay, now you have the 210 call that you paid $18.65 for, except now it only gets to 230. Now your option's worth $20 intrinsically. You still made a profit of $1.35 and got a 7% rate of return. Okay, you were wrong, at least on the opposing zone. You still walked away with a profit and a rate of return. And for those of you who said we could have bought two of these for less than one of those, that's true. And if the stock had made it to 240, you'd have had more money. But if you're just comparing one contract to one contract, you got a 225 call, the stock went to 230, your option is only worth $5. The stock went up and you took a 260 loss, or you lost 34%. Not to mention over here, we already know if the stock, just at 240, that guy took max loss, and now you've got a 100% loss. These are what freak out new options traders. Man, I bought a call option. I mean, even not buying out of the money, I bought in the money. And this is where trading comes into play. You have to know where your profit target is. See, here at Pinnacle, we talk about supply and demand, and we teach market timing, or the probability of identifying market turning points based on trading with the big money institutional orders or finding where they are. Okay, so if you didn't have the right profit target, if you thought your profit target was only 230 and bought this option, well, you've made it that much harder to make a profit. However, by going further in the money, you've reduced your break even. And even if it doesn't get to your initial profit target, it is still possible to make a profit, albeit a smaller one. But both of these, the stock went up and you took losses, let alone max loss, you still took losses on the trade. All right. And as I talked about before, an even bigger retail mistake is thinking there's no difference between the call options. A call option's a call option's a call option. Stock goes up, I'll make money. Well, yeah, doesn't work that way. Okay, if you don't understand the difference between in the money and out of the money options, and we didn't even talk about expiration dates today, volatility, time decay, those are all other things that can hurt your option premium as well. Okay, so any questions? We're right here at the 1 hour mark, right on time. That's the pros and cons of in the money and out of the money options. And by the way, I want to just show you one other thing. Even when we came back to here, okay, even if the stock we came back to here, even if the stock went to 250, I'm sorry, I want to go back to here. Even if the stock went to 250, okay, remember this? The stock went to 250, that this one was still the 450% rate of return, this would be worth $40 and we'd have even more profit. So at the end of the day, guys, even though this still had the sexier rate of return of the 450% when we got to here, remember this one? Hold on, there we go. 450% rate of return. We would have had even we'd have $22 of profit on the 210 call instead of $8. All right. So I want to thank you for spending some time with me today, talking about in the money and out of the money options. My name is Steve Moses. I am the options guy at the Pinnacle Institute. We teach all the asset classes. We have introductory workshops for those with no or very little trading experience. Sam Seiden does the advanced. I do the introductory workshops. Sam does the advanced workshops on our ability to teach market timing, or the probability of finding the big money institutional orders, so that you could, in theory, trade getting in, getting out when the institutions get in, if you understand how institutions trade and how they scale in and out of positions over time. Okay. And frankly, as cool as options are a derivative of underlying stocks. And if you don't have reason to be bullish on a stock, you shouldn't be in a bullish options trade. If you don't have reason to be bearish on a stock, you shouldn't be in a bearish options trade. And talk about what I just showed you. If you have the wrong profit target, you could be right on the direction and still lose money. So learn trading, learn options, and if you're into it, join us in any of our webinars. I'm doing our introductory workshop tomorrow morning at 10 o'clock Eastern Time, 7 Pacific. Sam has one tomorrow as well. So, okay, gang, welcome aboard. Thank you for joining us today. If you got any questions, by the way, my email is steve.moses@pinnacleinstitute.com. Would love to see you in some of our workshops. Thanks for spending an hour with me today. The session will be recorded. I'll be doing another session at the end of April. Usually the last Friday of the month, I'm choosing a topic on options. I used to do it just for beginners. Now we're going to do a little more, for slightly more experienced people. Maybe we'll do one on puts next month, but keep in touch if you are so inclined. And again, thanks for joining us, and hopefully we'll see you in either of our workshops. Have a great rest of your day, and have a great weekend wherever you are in the world. Thanks very much. Bye-bye.